Welcome to Harnessing Your Wealth with Billy Peterson. As the founder and CEO of Peterson Wealth Services and a former #1 ranked jockey, Billy knows what it takes to succeed. In this podcast, Billy and his team will help equine enthusiasts, business owners, and retirees understand the keys to financial freedom. Saddle up and get ready for a ride you won't soon forget on how you can harness your wealth.
Well, here we are, Shaun. It is 2025, and we're here to talk about the economy. We're here to talk about the markets, a lot of new policies that we expect. We're kind of taking a rearview mirror look at what happened and what's likely to happen based on what President Trump has discussed, or President-elect. I guess he still hasn't been sworn into office, but that's coming. And we know there's going to be a whole host of new changes implemented. But we want to take a minute, maybe start with where we have come from and what we expect to see with this new administration in light of the changes. So how about I just take a quick stab at the economic outlook? Right now, we're expecting a slowdown, a slower trend in 2025. We've been talking for months about inflation, the Federal Reserve, and, a needed slowdown, really.
Yeah. I mean, things feel like it's been on a wild ride since 2020. A lot of money was pumped into the economy. Lots of people feeling pretty fat with their wallets. And now that's starting to dry up a little bit. The M2 money supply is kind of coming to where it's people don't have as much to spend. And maybe it's a little bit of a slowdown. Rates are so high with personal loans and mortgages that it's kind of just headed that way. I mean, we've talked about this before. Is this the most signaled recession we've ever seen?
Talked about it for years.
Hasn't happened yet.
Recession hasn't happened yet.
Are we in the middle of it? Again, when we say recession, sometimes people, their stomachs drop and they think the first thing they think of is 08, 09, the real estate collapse. And I don't believe, and Billy would echo this, that it's something that extreme. But you've got to slow down at some point. And there's a lot of changes that President Trump's talking about that could cause some slowdown before what we believe could be a great expansion opportunity for people and businesses.
Yeah. We're going to look at both sides of the coin. I don't want us to ever be seen as just perpetual bulls, they call them perma bulls, where we're always optimistic about everything. We have to look at both sides. So there's a likelihood that this slowdown triggers a recession. What does a recession look like? Is that a long-term, extended, protracted recession, or is it something that kind of is a little bit rougher of a landing, and then we find a way to stabilize and the growth of the economy resumes? So if we slow down year-over-year growth, what's called GDP, gross domestic product, we're looking in 1.5% to 2% range for those of you who track the economic statistics. Jobs as a whole are pretty solid right now, but we're going to see a slowdown. Consumer spending, Shaun hit on that a minute ago. We've kind of grown into two separate economies almost in this country, where you have the haves and the have-nots.
Yeah.
And you have the haves are the wealthy that have gotten more wealthy because of this flow of newly printed money. And obviously the markets have expanded significantly. So people who are fully invested have made a lot of money in returns. And then you have the have-nots, the people that are trying to make it day to day, who have seen cost of living rise way, way further than their wages have risen. Yeah. And they can't sustain their lifestyle. They're being squoze. And so we're going to see a potential slowdown from that side. The vast majority of the population is in that camp, right?
I think so. And we talked to a lot of people. Like, we had a client in here that does anesthesiologist work for elective surgeries. And he's saying people are not electing to do those surgeries. And, that's a sign of an economic slowdown. Talked to some folks in the construction world that maybe seen a little bit of a slowdown. And again, we're not trying to scare everybody, but it's just things that we're actively looking for. Does that mean we run for the hills? Absolutely not, because we never know. Recession, market corrections, they may not happen when we think. Yeah. So you've got to remain invested. But you need to look at certain sectors that make a lot of sense. Go ahead, Bill.
The job losses that we're kind of touching on could largely come from a slowdown in the spending, which leads to potential some businesses to say, hey, we're going to ratchet in some of our business lines. We are going to cut some of the jobs that we built or added in the last 12 to 24 months. And also, as we've talked extensively about the government spending or the recklessness of it all and what needs to happen. And now you see, or at least is projected all over the media, that we have Elon Musk and Vivek Ramaswamy who are coming in to save the day. They're coming in to
trim the fat.
Take a sword to this reckless spending. The government actually has propped the economy up, and I think I would use the term artificially, because when the government spends money, they didn't create the money. It was just printed. Technically, it was just floated out there. So what we're going to see is potentially a real big slowdown in one of the largest, the largest employer in our country, when you see a lot of jobs. Now, hopefully those jobs can be just transitioned to a different part of the economy, and they won't be building a huge unemployment rate. But we are going to watch that. That's one thing that we're really, really going to watch. The other thing we're going to watch is the savings rate, which is falling drastically, and it's below trend line. We call this the personal savings rate for all Americans, and currently sits at 4.4%. The trend line is 6.2%. So whenever you see people unable to save money, that means there's less discretionary spending, which eventually leads to a slowdown in the economy. That's just one of the things I think is a point that could be on the negative side of things, as we need a slowdown, but how much of a slowdown?
Yeah, and that savings rate peaked at like 32% during COVID. Again, why? Because we threw a lot of money at it. And people say, well, why don't we just keep doing that?
And we wouldn't let them spend it, Shaun.
And we wouldn't let them spend it. So everyone was saving money.
Locked
they were giving money.
Didn't go anywhere.
You know, the PPP loans, all those programs that were out there. And I've had friends say, well, why don't we just keep doing that? Well, look at what it's caused. We've got inflationary environment. That's why we don't keep doing that. You keep printing dollars and throwing them out there into the market that are not worth as much. That's the basic explanation of it.
Yeah.
The national debt, it's on our minds. It's starting to kind of become more of a headline. We're talking $36 trillion in national debt. Really no solution in sight. In my mind, there's two ways you fix that. You tax more, you spend less. President Trump is not on the tax more side. No. You know, his Tax and Job Cuts Act is likely to get renewed. So it's going to be, like Billy said, people coming in and, you know, seeing, is this really efficient? Is this program really needed? Where can we save dollars internally, which I'm a fan of. And
I agree. And we look at it from the standpoint of just common sense. If you want to balance your household budget, you have to make some sacrifices. Mm-hmm. So you have to cut back on some spending. A lot of couples have this challenge. You know, you have a spender and you have a saver. And where do you come and meet in the middle? Mm-hmm. Right now, we have nobody but spenders. I mean, there's very few people who actually want to be fiscally responsible. And that really goes back to things I've said all over and over again, is because it's a conflict of interest. If you're trying to save and cut, then you've got to tell people in your district or from your state or whoever elected you that you can no longer spend on the things they want spent. And, well, you just kissed your ass goodbye on the re-election because they don't want to hear that. See, people are addicted to spending and money spent on them.
True, but maybe there's a change. I mean, Donald, he won the popular vote, and he was pretty adamant about you got to spend less, you got to tighten the belt. So maybe people are seeing the effects of that going, hey, maybe this isn't the right type of policy.
So, yeah, let me ask you this, though. So he's going to cut taxes, which cuts the revenue. He's going to cut spending, hopefully by a like amount. But where do we start getting on track to balance the budget, or just cut the deficit year over year and then maybe start attacking the debt?
Well, one way to think about that is if you're a business owner, which you are, and we work with a lot of business owners, if your taxes are cut and you've got more money to go around, what are you going to do?
Well, you got more money to spend and hire and expand.
Increase wages, right? Mm-hmm. And then people spend more in the economy. So that's a roundabout way of stimulating the economy. That's kind of the conservative approach that way versus forcing it to be taxed on you. Because if you know you're going to be in a higher tax bracket as a business owner, you might tighten your own belt, saying, hey, I don't know if I can give you that raise this year, or I don't know if I can go expand and open a new office or buy that new equipment. So maybe a double-edged sword, but I like hey, let's less regulation, let's maybe lower taxes. And some people look at that and say, well, that's corporate greed, or that's billionaires getting all these breaks. You guys, who provides all the jobs?
Yeah,
big time business owners.
You want to run them out of the country because you continue to hammer on them. That's just the shallow way to look at it. And you see a lot of these young, uneducated kids who have been told on TikTok that capitalism is evil.
Evil.
So our country is founded on this, and we have the greatest country in the world because of this. So let's not take that away. So anyway, back to the kind of this
little
conversation,
there. Yeah.
But we love going into some of the weeds, because people, I think, become misinformed about what really triggers inflation, that what could trigger an economic recession, and what things we're wanting to pay attention to. That leads to the next big topic of discussion is interest rates in the Federal Reserve. So where are we at right now? They've cut twice. And there's another meeting started, I think, today. Well, actually, by the time this show is produced, that meeting will be well in the rearview mirror. But what we're getting at is, where are they? Because they've really softened their tone on what they're going to do with interest rates. Just a few short months ago, before the election, everyone was convinced we were heading into this regular cycle of interest rate cuts because they've whipped inflation. Well, Shaun and I, everyone in the office, have talked at nauseum about how false that was, all the way back to 2020, 2021, when we heard nonstop from the Biden administration that inflation was transitory. And then they got this whole Inflation Reduction Act passed, which was nothing more than a title which sounded good, but was a complete fabrication of the facts, because it didn't reduce inflation. All it was a way to funnel money into these pet projects. So what we're trying to do is say inflation is directly tied to the M2 money supply. Money supply goes up, inflation is going to go up. Shaun touched on it. It's all about the dollars and how valuable they are in the economy. Mm-hmm. Where does the Fed go? Are they going to cut, pause, or raise? If they raise, we got a problem in the equity markets, because the markets don't have that priced in at all. No. And they're now trying to incorporate what's called a soft landing, which is, all right, we've been at a real high peak on the economy. A lot of businesses have done very well. The lower end consumer has been squeezed, as we mentioned. They want to manufacture a soft landing and then start cutting again so the economy can come out of this contraction and start rising again. But the Federal Reserve has so much power. And I'm going to give you a quick history on the Federal Reserve. Do you know when that started, Shaun? Federal Reserve was created in 1910 on Jekyll Island. It's a small island off of Georgia, and this was coupled with 3 or 4 important people back in those days. Mm-hmm. All right, J.P. Morgan. You had a lot of people who felt like they knew the best way to handle banking and the banking sector and how money should be available and who should be in charge. Well, the Federal Reserve is not even regulated necessarily by the government. It is non-elected people who are in control of all of these decisions, really, really important decisions on interest rate policy and where money is, how easily money is available to us all. There's been a lot of critics against the Federal Reserve over the years. Milton Friedman was one who was very critical for a long, long time and thought it should be done away with. Matter of fact, he called he said they have a legalized fashion of counterfeit printing money. Really, if you think about it.
Think about
it. They can counterfeit money, print all they want, and it's illegal. It's legal for them to do so. There's no one to regulate or tell them no. They answer to no one, and they have nothing to back that. It used to be we were on a gold standard, right? So you had something physical that would hold some kind of backing of the dollar. And so you couldn't just keep printing. You had to have something in deposit to say, we have this much to back that up. Now we just issue paper lottery tickets almost, certificates. Here you go. You can have as many of these as you want. Rand Paul is another one. His father, Ron Paul, was really, really critical of the Federal Reserve. Those kind of guys are few and far between because you go against the system, so to speak, or the machine. The politicians kind of gang up on the one who is the odd man out.
Right.
So how good of a job has the Federal Reserve done? I would say they've done a fairly poor job at keeping us out of recessions, at keeping the dollar stable. Look at it. How would you grade them? Not very good.
Maybe a C.
Maybe
a C.
So that what they do is going to be something we watch very closely in 2025. And you might see Congress, since there's a mandate now on the Republican side, you might see Congress get maybe some kind of proposals to limit what they're able to do. Because Milton Friedman suggested that a computer system be in charge of money and interest rates based on certain factors that are triggered, rather than the
Milton
human
Friedman
element.
said that?
Yeah.
So he was ahead of his time with all this AI stuff? Because that's what, when you said that, that's what came to my mind. We're going to have AI.
This was in the 1960s. He was talking about this because he felt like human interference is a problem. When you have biases.
Just think about it. Everyone has their own biases. Believe it or not.
Political, even. And that's a bad thing.
So that's a little bit scary with that and what they're going to do there. I go back to that point you made, and it was, who tore the Band-Aid off in the 70s? What was that Fed chair's name? Volcker. So
Paul Volcker.
They thought they had inflation tamed and everything was golden, and it wasn't. Inflation was there and it was sticky. So he came in and just hiked rates and basically put the brakes on it, and everyone flew through the windshield. That was not priced into the market. Yeah, I would say that if as advisors looking at portfolios and everything, that's something that would worry us, because that is not priced into the market. If that is a scenario where we're in, where we go into this rate hiking cycle, I would say that could trigger us to go into a bear market. And, a bear market is a 20% drop from your last high. Yeah. And they're not fun. They happen though,
but they're normal, and we haven't actually seen one for a while. So the longer we go, the more we're due. Let's just say that it's something that needs to occur, but it's also something that no one can necessarily predict accurately to time. Because look, we heard, I don't know how many, the vast majority, so thousands and thousands of economists and financial experts discussed or predicted a recession clear back in 2020, 2021, 2022. It didn't happen. Okay. They were predicting it. All these things were going on. The triggers, the alarm bells,
the run for the hills,
the inversion of, the
yield
treasury,
curve.
The yield curve inverted. And well, guess what? All these things that are so predictable of a recession didn't pan out, because everything changed when they printed that kind of money. Everything changed. And I don't know, it's just getting a little bit to a point where that sooner or later things trend back to averages. So let's talk about the averages. Most of you want to know what we think about markets and what to expect going forward. Equity markets 2025, we think there's going to be more volatility than there has been. We've only had 2 or 3 of these little corrections. We call them 5% corrections, and there's only been a couple in the last year. So these 5% pullbacks, what do we have? 2 last year?
2 last year as it stands now. And normally, 5% pullbacks, the average is around 5 per year.
Yeah. To
see a 5% pullback. I think 10% it's once per year. I think we got close to that in 2025. Maybe the NASDAQ.
8, I think. Yeah. There was a small period where things were a little uncertain.
Yeah.
But the last time we had some volatility like what we're expecting was in 2022. We had actually 12 of these 5% corrections, 12 of them. And we've been the last couple of years low single digits, 3 and then 2. So again, we expect more volatility. Yeah. The current valuation on the S&P 500 is 22.4 times earnings. So that's what's called the PE ratio, 22.4. It's beyond what we think is a sustainable or a comfortable level. So how does that correct itself? Well, either the values come down, prices come down, or the earnings go up in order to meet the level that we feel more comfortable with. So earnings, it's basically what multiple are we going to put on the earnings to pay for forward earnings? Now, in the technology bubble in 2000, the market PE peaked at 24.5 times earnings. So to give you a little bit of a context, and from there, the market had a significant sell-off. Technology stocks dropped 70 to 80%. S&P 500 dropped 45%. Once again, what happened? Well, we had some poor Fed policy. We had earnings that were growing but needed to stall and needed to slow. And then they were kind of yanked, everything got yanked out from under it by Federal Reserve rate hikes, and then a drastic slowing of the technology sector spending. So, could that happen again? Possibly.
One difference, though, that you've always kind of told us about is a lot of those tech companies had zero earnings.
Yeah.
They were just fly by night. The companies you see on the movie Wolf of Wall Street, which is a pretty good movie, but not for children.
Yeah,
okay, just to be clear.
Be careful.
Be careful. But I think that was another factor in there where a lot of these tech companies now have solid earnings, but it doesn't mean that they're not overvalued at some point too.
You have to watch that. I mean, the only reason people would spend this kind of money to pay for forward earnings is if they expect earnings to continue to accelerate. And when you say earnings, it's really make it simple. That's what we like to do here in this office, is make things simple and easy to understand.
Mm-hmm.
You're paying for companies' forward earnings. So think about it. If you had a business and somebody said, I'm going to buy your business, well, you'd put a valuation on that business and you'd say, well, you're going to pay me for what this business is today, but also it's already established and it's going to have future earnings. So you're going to pay me a multiple of the earnings, not just today, not just what it already did. And that's what we're doing in equities. We're paying for those forward earnings that we're expecting to go forward. A lot of companies are growing their earnings by 40% or more.
Crazy.
So that's why, hey, if they're growing earnings at 40% and they're trading at 40 times earnings, well, you're only paying for 1 year's worth of earnings in advance, right? So think about when you sell a business, if you're a business owner, you're typically looking for 5+ years of earnings in advance. That's called a 5x EBITDA multiple, 5x, 6x, 7x sometimes. So what are you going to pay for some of these companies in the S&P or the NASDAQ or these high flyers that are growing at 30, 40, 50%? Then it starts to become maybe a little less crazy in your mind of what you're willing to spend for those forward earnings. AI, artificial intelligence, we think is a game changer. We think those companies' earnings is very sustainable, the earnings power, because it's changing the whole landscape of how we operate, how we function as a society. It's one of those areas that is growing so much more rapidly than these mundane, boring companies like the energy sector or some of the banks and financials or insurance companies. These companies are accelerating at multiples above these old standby blue chips. Yeah.
Which I think opens up room for opportunity where we haven't seen returns dispersed amongst all the companies. Okay, when we're talking markets, typically referring S&P 500 largest U.S. companies. And the returns have been very, very concentrated over the last 2-3 years in some of these tech names. Also, another thing we're seeing is money on the sidelines. I'll call it cash and money markets. Dang near all-time highs.
I think it is all-time highs. The last
all-time high. I mean, people are getting lured into buy this money market. They were getting 5.5. We looked the other day. We're down to like 4.5 on some of these money market funds. So those rates are going to start to come down. If the equity markets do correct, people are going to step in and they're going to see value. At least smart money is.
Yeah, you hope. You hope the smart money would come out of money markets. The one thing I'll also add to that conversation, the money markets, that makes me encouraged is when you have money markets at all-time highs, that means people are not invested. They are
pessimistic.
They're careful. They're scared. They're nervous. $6.7 trillion in money market funds as of yesterday is huge number. And that means that people are not speculating on stocks and they're not buying. When I say speculating, they're not taking risk. That makes me more optimistic.
Me too.
Back when the 2000 and the dot-com bubble and the real estate bubble, you didn't have a lot of people sitting in the sidelines. You had people going all in because they were looking at their neighbors and their friends and their coworkers making a killing in tech stocks or in real estate. So everyone wanted a piece of that pie.
When you start getting the calls from the 80-year-old grandma or grandpa,
Aunt Lorraine, they're coming in.
Peterson clan, I'm looking at you. When you start getting calls like, hey, I want all my money in this XYZ company, and it's a company that we haven't heard of, that's a red flag.
Watching Jim Cramer on TV.
When everyone
he tells me to buy this stock.
When everybody's wanting in like that, that makes us a little bit wanting to go the other way. Right. We're always trying to kind of go against the herd, and we haven't felt that yet where there's all this optimism in the equity markets.
It's your contrarian indicators.
Yes.
And we actually have some clients that we use as contrarian indicators.
Good.
Of when they want to buy and when they want to sell.
We ought to patent that.
It's time that we're going the other direction because they're kind of...
I mean, if I'm sitting here listening, I'm kind of saying, well, are you guys scared, Billy, Shaun? And the answer is no. But we do need to prepare people. And remember, that's why we lean on people's financial plans. I wrote an article in our newsletter about this. If you haven't gotten it yet, it's coming out. But lean on your financial plan, maintain a diversified portfolio, and make sure you can, like your risk score adjusts or aligns with your portfolio. Okay? Mm-hmm. That's what we're here to make sure we're doing, is because we never know. We do not have a magic ball of when the markets might correct or we might dip into a recession. But we do have the knowledge to know, hey, sometimes these things are going to happen, and let's talk about it. What are we going to do? How are we going to adjust portfolios? Are our clients aligned the right way with their distribution plans? All those things are factored into this. It's not just, did the market correct today or not? There's a lot of different factors that go into it. I think it's important.
So here's maybe the last discussion point, Shaun.
Okay.
What do we think? And what do you think with Trump now coming in to take his second term? What's the outlook? Are we excited? Are we nervous?
I am excited.
Why?
Because I think he's pro-America. Never seen anyone like that in a long time, and it feels good. And I think he's actually united people. I have Republican friends, I have liberal friends, and everyone seems to kind of be saying, you know what, I'm kind of excited about this. It was time for a change. That makes me happy to hear. Flip side of that, some of the changes that he's wanting to do, tariffs, whatever it might be, can't just happen overnight. So I look at it as you pull a Band-Aid off, hurts for a second, and then all of a sudden it feels better. I think that might be where we're headed in the first half of the year to get some of these things adjusted. But remember, like you said, Billy, this is capitalism. These companies, they've seen different cycles. They know how to produce a return to their shareholders, earnings to their shareholders. So I'm very, very optimistic. I'm not calling for another 20% year. I don't like to put numbers on what the indices are going to do, but I think overall it's going to be very good. And especially if you're a longer term investor, which, 3+ years, I think it's a good opportunity.
I'll add my 2 cents. I am very optimistic too. And I am kind of a realist. I look at things from I think of myself as a common sense type person. And the things that we were doing in this country, the money we were spending, for example, and if you actually got the list, there's dockets that have what we have been spending money on in this country and allocating tens of millions, if not billions of dollars to as a country, and we're in debt up to our eyeballs. It makes zero sense to me how these government officials can get away with it. I am flabbergasted all the time how they can take our money, taxpayer money, and just keep spending as if it's nothing to worry about. The government can ruin a lot of things real quick if you let them. And why I'm optimistic about Trump is he's not one of these insider governmenters. He's not one for big and more government. And it just feels different now. It just feels like, hey, he's part of the people. And right. you love him or hate him. I know there's a lot of people that hate him. And, personality, he's brash. He's a New Yorker. He talks direct. He's not nice, to everybody. But why not just give the guy a chance? The media has berated and trashed him and made every move he made ever since he came into office, so much more difficult than it needed to be. And most
now
of them were lies.
Now, guess what? Time Person of the Year.
Yeah.
When I saw that, I about tipped over. I was like, how in the hell did they name him? Because I think they realized, hey, he's been through hell in a handbasket.
You know the other thing, Shaun, that they've done away with? Remember 3-4 years ago? DEI was the thing.
All those companies are backtracking.
They're done now. It's over. I mean, everybody, not everybody, we didn't, but so many people bought into that garbage. And do you think as a company, a business owner, an executive, a CEO, that it's better to hire somebody based on their classification or a box that you check or something that just makes them unique, but nothing to do with their skills or their merit or their ability to add anything to the company?
It's wild.
It is crazy.
It is
the
crazy.
thinking there. The thinking
I think a lot of that crazy talk is already going away.
Thank God, because again, I'm not trying to praise this thing yet. I am open-minded, but why not? Can't we just unite and try to look at this country from one perspective, from a standpoint of we're all going to benefit if we can get Trump's policies to put in place? We're all going to hopefully benefit, right? And I know that everybody thinks this, the climate change and the DEI and, the mass deportations. Well, there's, take a look at the other side. So there's only one news network that talks about conservative, and then there's about 10 of them that talk about everything that they hate about conservatism and about Trump. Maybe open eyes a little bit to see what positive can come out of keeping our laws, keeping our borders, not spending money we don't have, because all these people, these migrants, immigrants that came in illegally, guess what? They're taken from the system. They're not adding to it. They're taking from it from the most part. Where does that money come from? We don't have it. So everybody that's mad and pissed about, deportation, how many of them are raising their hand to take a few of these families in under their own?
Well, I've seen the videos
roof.
on Instagram. None. They drop them off at their houses.
We're not trying to be cold-hearted here.
I'm not.
But man, let's make sense of it from a financial standpoint too. So a lot of things to think about. We're watching all these metrics and the data feeds. The Federal Reserve, I don't love it. They're $100 billion. Did you know this? The Federal Reserve has lost $100 billion each of the last 2 years. And they have no accountability for it. You know who bails them out? The Treasury Department.
Yeah.
The taxpayer.
IRS. Yeah, that's all.
Hello. I mean, I don't know, guys. I'm not trying to get an uproar going here and an uprising, but something needs to change. And I'm excited to see if what we've been told from the Musk group and his kind of cutting some of these unnecessary expenses. I'm excited to see if that.
We'll see if it comes through. I tell you all the time, people talk a lot, and sometimes there's not a lot of change. And I'll hold the Trump administration accountable, just like I would the Biden administration or Obama administration. If I see something that's not going on, we'll call it out. I promise you, we will.
100%.
I'm not going to be biased.
No, we're not trying to be biased. We're just trying to be optimistic about the future.
And for what we're hearing, when we meet with clients, people, everyone's excited.
Yep.
I've yet to hear someone say, I'm not excited. I think this was a horrible outcome. But you know what I am excited about? That sign behind you.
Isn't that sweet?
Has everybody noticed that? I hope you have by now. Yeah. We're 30 minutes into this, but guys, the podcast room is looking really slick. Billy has been cracking the whip to get this thing together.
If you haven't been here yet, you need to stop by the office and take a look. Take a look at our podcast room. We're really excited about it. Yeah. Now, that doesn't mean we're not working, because we do this when we're
after hours right now.
After hours, got a few free minutes. And, obviously it's a good way to bring our thoughts and opinions to the world, and you can share with your friends and family members or whoever. We hope you like these shows. We have a few great guests already lined up as we go forward. We thought it would be important to talk about the economy and our outlook, and maybe some future policy decisions that are going to impact all of us. So it's important to know what's going on, to be educated about what's happening. Help your kids, get your kids started with these financial concepts. They don't teach them enough in school, and that's a problem, okay? Yeah. You have to take it upon yourself to learn some of this stuff. And if you want your kids to succeed, you can say all you want about getting, going to school and getting good grades and all that. But, I think that takes a far, far rear view, second place, third place to learning basic financial literacy concepts. Knowing how to manage your money, knowing how to minimize your debt, knowing how interest rates work, taxes, compound interest, investing, the types of accounts, how to avoid taxes. So much goes on, and we just want to help you guys understand it. So please keep watching. Share with us your feedback. Like us out there so we can continue to grow the show, help others in this world. That's what we're all about. We don't get paid or any advertisement dollars from this, but
not yet. Not yet.
Shaun's trying to get us out there. We're going to start getting some paychecks out of this. But hey, we love you all. Thank you for listening. We'll talk to you again on the next show.
Thank you.
Thank you for listening to Harnessing Your Wealth with Billy Peterson. Before we declare the race official, please click the follow button so you can be notified when new episodes become available. For more information about today's show, please check out the show notes. Visit our website at www.petersonws.com or give us a call at 801-475-4002. Once again, thank you for listening. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Peterson Wealth Services. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.